Hello and welcome to video 9 of the Licensing Education Series by AIC, a partner of American Senior Benefits. Please watch each video all the way through once without taking notes, and then go back and take notes. You'll find that you retain more information that way. If there are any topics you would like me to do a deeper dive into, please comment to tell me the specific information you want me to go over. Thanks for attending, and let's get started. So this video is going to continue provisions, options, exclusions, clauses, and rights of life insurance. Again, I'm just going to follow the list of topics that are on the outline of the Oklahoma exam. If there are any others you would like me to go over, please let me know in the comments. So for life insurance that has cash value, the policy owner can take loans. The loans don't ever have to be paid back. But they do accrue interest annually. And if that loan is not paid back, the death benefit will be reduced by the amount of the loan plus interest. Policies usually allow up to 90% of the cash value to be taken in loans. And as long as this policy is still in force at death, the loan is not taxable. If the policy ends before death, any amount taken in loans that is in excess of what the policy owner paid into the cash value, which is called the basis, would be taxable. So, for example, if they had a cash value of $100,000, and what they had paid into the cash value was $80,000, well, 80,000 of it wouldn't be taxable because they already paid taxes before they paid for the life insurance on that money. So they'd only be taxed on 20,000 of it. All right, universal life and variable universal life usually allow for partial surrenders. Also sometimes called withdrawals. Instead of a loan, which generates interest, a partial surrender just takes the cash value without any intention of paying it back, so there aren't any interest charges. But that makes it a taxable event. However, life insurance is treated as first in, first out, which is it means that the partial surrender amount is considered to be taken from money that the policy owner paid into the cash value, or the basis, first. Since that money was taxed before being used to buy the insurance, any partial surrenders up to the amount paid in are not taxed. Only partial surrender amounts in excess of the basis are taxable. Since they would be taxable, usually anything in excess of basis is taken as a loan instead of a surrender to avoid taxation. So, following this law, if you wanted to take a surrender of, let's say, $50,000 and you had $25,000 basis, the first $25,000 would be as a partial surrender. The next $25,000 would be as a loan. Because remember, those aren't taxable if the policy is still in force when you die. Okay, so if a life insurance policy with cash value lapses, the policy owner will receive the remaining cash value in the policy in one of three ways. Those ways are called non-forfeiture options. They're called non-forfeiture options because they're not forfeiting the cash value that's in the policy. The first way is just to take a lump sum of the amount that's in there. The second is called reduced paid up. This way reduces the face value of the life insurance to the point that the cash value can be used to pay the premiums. The third and default method is extended term. And the reason this is the default method, so if the policy owner doesn't choose a different option, that's the one that automatically happens. This pays up a term policy with the same face value as the original policy. The difference is this one won't last the rest of your life. It only lasts until the money runs out. So the reduced paid up reduces the face value, but then it remains a permanent policy, just for a lower value. Whereas the extended term, that keeps the same value, same face value, but it isn't permanent anymore. Okay, some life insurance policies also pay what are called dividends. I touched on it on an earlier video, but a dividend usually happens in life insurance companies that are owned by the policy owners instead of investors. Insurance companies owned by the policy owners are called mutual companies. Ones that are owned by investors are called stock companies. And those usually don't pay the dividends. Life insurance that has potential dividends are called participating policies. And ones that don't pay dividends are called non-participating. Dividends are actually a return of overpaid premiums. If the participating life insurance either has fewer people die than expected, has lower expenses than expected, or their investing does better than expected, the excess money gets returned to the policy owners. Since this is a return of premium paid, there are no taxes on dividends. There are different dividends you might see when you're looking at the stock market. That's not what we're talking about here. Now, if the policy generates a dividend, the policy owner can take it in various ways. The first is just to take it in cash. The second is to leave it in an account with the insurance company and gain interest. The third is to buy little chunks of extra paid-up insurance with it. The fourth is to apply the dividends to the premiums to reduce the premiums. The fifth is use the dividends to pay up a policy early. The sixth is to use the dividends to pay for one-year term policies. And the seventh is to add the dividends to the cash value. Now, doing this might cause the policy to endow early. Remember, endowing means that the cash value equals the face value, so there's no insurance anymore, so it just pays out to the policyholder. So a lot of options, but they make sense. You either can take the money, leave it there in an account with the insurance company to grow. You can buy additional insurance. You can lower your premiums, or you can add it to the cash value, essentially. Okay, so when the policy is taken out, the policy owner can select from various settlement or payout options. The most usual settlement option is taking it as a lump sum. You have $100,000 insurance, person dies, beneficiary gets $100,000. However, there are other options that a policy owner could consider. The death benefit can be for interest only. So the death benefit's actually kept at the insurance company to earn interest, and only the interest is paid out. It can be set up for a fixed period option, a certain number of years, like over 10 years, or for a fixed amount option, like $2,000 a month until it's gone. Or it can be paid out in the form of a life annuity. For the life payouts for the annuities, refer back to the annuity video to see how that works. In some cases, the insurer will work with a life insurance applicant to design a special settlement arrangement. Now, as I mentioned in previous videos, the owner of a policy can assign it. That means transferring some or all of the legal rights of the life insurance contract to another party. The life insurance company has to be notified of the assignment. Assignment may be done for several reasons. For example, someone may want to give a policy to someone as a gift. That would be a voluntary and complete, aka absolute, assignment. Another example would be using a life policy as collateral for a loan. The policy owner would make a partial or conditional collateral assignment in that case. Partial means the lender only gets rights to the cash value and or the death benefit, and conditional means that they only get to exercise their rights if the policy owner defaults on the loan. So if you use your life insurance as collateral on a loan, the lender would be able to take the cash value if you default while you're still alive, or the death benefit if you still owe when you die. And if the policy owner defaults, they can exercise those rights. So that's what the conditional part means. In the case that the beneficiary of the policy is irrevocable, as discussed in the previous video, that beneficiary may be able to use the death benefit as collateral assignment. Policy premiums may be different based on age or sex. So if there's a misstatement of age or sex on the policy, and that would have changed the amount of insurance, the claim will be adjusted to match what would have been the correct age or sex. If the state allows, there may be a provision that allows the insured to order and pay for a medical examination if the person files a claim while still alive, or an autopsy if the insured has already died. This would only apply if the policy is still in the contestability period. Also, the insurer would pay for this. Some policies may have a conversion privilege. This allows the client to switch their policy from one type of life insurance to another. A common conversion privilege is one that's seen in term policies that allows the policy owner to switch the term to a permanent policy. And we have the spendthrift clause. A spendthrift is someone who can't handle their money very well. So the spendthrift clause is designed to protect a beneficiary from themselves. Basically, the spendthrift clause keeps the money from the death benefit out of the hands of the beneficiary. And then the beneficiary is paid like an allowance instead of a lump sum. This protects them from running out of money and also protects the death benefit from creditors. The spendthrift clause is usually set up with the policy as it's applied. Most life insurance contracts include exclusions or limitations. Those are basically situations where the life insurance is limited or has no coverage. For example, some policies won't cover someone in the military, while others might cover them if they're killed or injured in a non-service related event. They also may exclude hazardous hobbies like skydiving. Another exclusion that's pretty common is criminal activity. But there are some provisions that are prohibited. The ones that most states have are they can't have a time exclusion of less than 1 year for bringing a lawsuit. So they have to give the person at least 1 year to file a lawsuit. They can't have a provision that allows the insurer to settle for less than the face value plus dividends minus any debt, like loans upon maturity of the policy. They can't have a provision that allows the insurer to forfeit a policy due to failure to repay a loan or loan interest, as long as it's less than the loan value, like that 90% we talked about during the loan section. So they can't cancel for loans. They can't have a provision making the agent of the insured instead of an agent of the company. So the agent is for the company. They also cannot backdate a policy more than 6 months to conserve age and or not collect premiums for those months backdated. So it has, if they're going to backdate it to, let's say a person wants a policy and they apply and their birthday is tomorrow and the policy doesn't get issued for 2 months, the insurance company can backdate it for 2 months to keep the old age, which means a lower rate. But they can't do it for any more than 6 months. So it has to be less than 6 months. And they also have to collect the premium for any of those backdated months. Okay, so that is the end of the life insurance provisions, options, exclusions, clauses, and rights. The next video is going to go over life insurance riders. Please like and subscribe so you get notified when new educational videos are released, and thanks for watching.